Hi, everybody, and welcome to the Middle Class Investor this week. This is Seth Martin, your host. It is about 10:30 on Sunday evening, August 12th, and we've got a chart of the S&P 500 up, and you can see that we had a down week. This is where we closed last week, and so the market opened down, ran up, and then pushed all the way back down to a lower value. So it could be. I mean, here's the obvious. We're very close to the top here. The top is right here, and of course, if we make a new high, this is likely to, make its way up considerably higher from here. But there's a chance that it doesn't make a new high. One of the things that I've been talking about is it's very choppy. This overlap kind of price action is very characteristic of a counter trend rally, and it still looks that way. And it doesn't look like anything that could be something that would make a new high. In other words, sometimes you can get an ending diagonal or something, but you can't even make an ending diagonal out of all this. So it doesn't look like really it will make a new high. But you never know. We're pretty close. I mean, the other side of the coin is the Dow Jones Industrials is way far away from making a new high, as you can see here. And so a lot of times when you get these divergences, it's kind of a sign that the market is heavily fractured. So you can see here we're not even to this high yet on the Dow Jones Industrial Average. But getting back to the S&P, something like 98% of this move up, if I can get back to it, there we go. 98% of this move up from down here to here was driven by 6 stocks. And that's like Facebook, Amazon, Netflix, Google, I don't know, a couple others. So there's like 6 stocks that have driven this market all the way up to here. And essentially all the other stocks in the S&P 500 have not contributed into this move up. And now you're starting to have some fracturing in the tech market, which is responsible for this move up. If you look at Facebook, you had this 20% down day in one day. If you look at Google's still near the high. Amazon. Oh, I know. One was Twitter that suffered kind of a big down. See, TWTR, I think. Twitter. Yeah, see. So Twitter had a big down. Let's see. NFLX, Netflix. Big down. You can see the big down here. Let's see how far down this was, because I don't know right off the top of my head, but we can check. So we had a sell-off there of about 22.5%, which is not insignificant. In just, what is that, a handful of weeks, 2 months really. Anyway, the point is, there's just the market, the underlying stocks that have lifted this index to these levels is starting to show some fatigue, and that could be the end of this, or not. But I think the fact that it's very overlapping and channeling. So if we look at, let me go here and look at the, let me look at the ES. So I want to show you the channel here that the market's been trading in. You can see right here, this is also indicative of counter trend when the price action is contained in the channel. Now, if this rallies back up and breaks out of the new channel and makes a new high, obviously, you know, all bets are off. But we got this big channel, and we do have some action here. It looks like things are rolling over. So we'll just play it by ear here for the next week or two and see how things go. Currently, right now, I guess we could have looked at that. Let's go back to the charts. Currently, right now, the S&P 500 is down 12.5. So we got a sell signal or a sell candle developing here, and it's 12 points down here after hours. So we'll see what the market open looks like tomorrow. Dow's down 117 and the Nasdaq's down 34 currently. All right. Well, let's look at some of the other issues. Looks like interest rates. Close that. So here's the 13-week Treasury, and as you can see, we're still kind of hanging along this channel line, this other trend line that I put in here. We're up to 2% on the 13-week Treasury, and the 10-year. Let's see what the 10-year is. 10-year pulled back last week, but is at 2.857. So this could be we could be getting just a sharp pullback here. And then getting ready for the next leg up. Because, well, let me go to a daily. Because the market pulls back in a channel, sometimes it's useful. I'm going to pull up a daily and zoom in here. This is likely, you know, the entire move here. This is probably ABC. You know, so we you know, I mean, I suppose we could pull back here into the 2.725 area. I was looking at I thought I saw something that looked a little different. We, you know, got this line here that's saying we could pull back into the 2.6 area. Which would make a lot of sense if the market really started to sell off. You know, if you think about it, what happens is when the equities sell off, you know, at least temporarily, people flood into bonds because it's considered, you know, a safe place to put your money. Think of it like, you know, just a buffer. Like I need to kind of create some time for myself to reevaluate. So they'll shuttle money over into the bond market to kind of park it temporarily. And it makes a lot of sense that, you know, if the market really starts selling off, you can see this trend its way down into this DP support area off the fourth wave low. This is likely the fourth wave, so 3 up to here, 4, and then 5, and then we're likely getting some sort of pullback into this area here. And of course, once you have if this is 1 and then this is all 2, then, you know, what you have next, you know, is a big 3. So that's likely what's happening there in the 10-year Treasury. Let's look at volatility real quick while I'm right next to it. Volatility, apparently, you know, obviously was up last week a little bit because the market sold off. Of course, it didn't sell off till the end of the week, so the volatility, most of this volatility happened toward the end of the week. Let me put it on a weekly. I had it on a monthly. There we go. So you can see the volatility happened toward the end of the week here. So we volatility gap. It opened up a little bit, but then sold off, and then rallied, and then sold off a little bit toward the end of the week. But still, net volatility was. Excuse the yawn. It's getting late in the evening. But volatility was net. It was up in the week. All right, let's look at some of these other countries. We like to do that from time to time. Many of these charts look a lot like the U.S. equities chart, except they're like this one's weaker. This is Germany. Germany actually looks weaker than U.S. equities. Japan is printing a lot of money, so they're working really hard to create inflation. I don't know why. Maybe they hate their people or something. But that seems to be their goal, to create inflation. But as you can see, the equities are not having any of it. They're still selling off. The UK, it looks a little weaker than our market, but they all pretty much look the same. Let's just go over to Thinkorswim charts, and let's look at gold real quick. Gold continues to look weak, but it looks like it's kind of slowing. The weakness is slowing, but we have this DP on here, and it could end up dropping all the way back. Now we are, if you connect these lines. Oh, right in here, we got a pretty strong. There's several channels in here. I don't have all of them drawn, but the bottom line is we're getting really close to. We're basically on this one channel. There's a one channel right through here, and we're basically on it. So gold, if gold pops up this week, and then we get a little pullback in gold, we could have recently bottomed in gold here. And we could be looking for some movement back in this direction for several months. Silver is, unless you really got in there and counted the waves, which is difficult, it looks weak too. But it's hanging right around here in this DP area. So again, if silver breaks this little green line here, which is it's an exponential moving average. It's a in this case, a 5-week moving average. So if it breaks up above this 5-week moving average, you might consider, being long silver, being long gold. Let's look at oil. Oil had oil was pretty strong into this last run up in here to about 75 and a half, but literally has sold off almost as quickly. It could be that it's getting a little bit tired here, and it may rally a little bit before it continues down. But I think you could see oil pull down into this 61, 62 area pretty easily before we get a rally. So look for that. Euro US dollar, the euro sold off sharply this last week. You can see here, it basically, if you look at this on let's say a 4-hour chart, you can see we broke through this pattern here, kind of retested, and then sold off. And this retest area is pretty common. It's a great trading opportunity. I think the euro's next big move, although it may not be done going down yet, it may rally a little bit and then go down a little bit more. But its next big move is going to be up into this 1.17 area. Just because this is likely the end of 5 waves. You can kind of see here 1, 2, 3. This is all 4, and then 5. And once you have the end of 5 waves, let's go to daily. once you have the end of 5 waves, you usually get some sort of pretty big retrace. Now, the bigger pattern here is 1, where this is 2 back up to here, and this whole thing is 3, and then 4, then 5, and then you get this chop in the next 4, and then 5. So it's either complete or pretty close to being complete, and so you could get a good rally up in here to the 1.18 area. Maybe not quite that high, maybe up into these old highs here around 1.175, and then maybe a pullback and then another rally up. So, but we should get, if you put this retrace all the way back to here, should be looking for a 62% retrace, 61.8, which is around this 121 area. So we could get a huge move in the euro, a big sell-off in the dollar, coming up here in the next several months. Let's see. We looked at oil, looked at gold. I guess that's about it. I mean, we look at the British pound real quick. The British pound continues to pull back sharply. We may get another look into this area here, although I think if you're looking at the euro US dollar, I mean the British pound US dollar may be a better proxy for the dollar, just because, well, I don't know, we'll see. It's there's right now the expectation is that the British pound is going to suffer from Brexit more so than Europe, but I don't know that that's actually the case. I think it's possible that people have that wrong. So, but whichever one you want to trade, if you want to trade the British pound US dollar or euro US dollar, it looks like, I mean, if you look at this run down on the British pound US dollar, it looks more substantial than the euro US dollar. It could just be that we're in different parts of the trend. In the euro, you're in a wave 4, but in the British pound, this could be wave 1, and we still haven't gotten into 2, or this could be like an ABC pull back into here, in which case we should have a 3 up, in which case this might be the better play, but we'll have to wait and see a few more cards come out of the deck before we can make that decision. US dollar JPY. The only thing I don't like about the JPY in general is there's so much central bank activity there, and I don't know, in some ways that can drive Forex charts really well, but they're also, these central banks could do so. You could wake up one morning and just get wiped out because they did something weird that you weren't anticipating. So I don't know. My focus is going to be on the ES and on the Dow this week, because I'm just curious to see if this is really the top or not, or if we're going to just pull back a little bit and then rally. So that's where my eyes are going to be this week. If there's anything you're looking at in particular that you want us to focus on here, comment in the comment section on the YouTube channel, and be happy to bring that up and discuss it here on the show, or we can discuss it offline back and forth with comments. All right, everybody, thanks for coming in this week. Thanks a lot for coming and watching Middle Class Investor. If this market really starts taking off to the downside, I think we really need to share this information with people in our family, friends, people like that, so we can help them prepare for what's likely to be coming. If Prechter's right, and let's pull up, let's look at the Dow real quick. If Prechter's right, and this sell-off, let's take the log off so you can see it. So here was 1929 crash right here, this little rundown here. And then what Prechter's saying is that this started a new trend. Okay, this started this was a new 5 waves here. So 1, 2, 3, 4, and 5. Well, if that's true, then after 5 waves, we could have a substantial sell-off and could end up coming all the way back. Well, I tell you what, let's just do this. Let's see what a 62% retracement from roughly from 1929 or 1932 to the top up here, where I don't even know where the top is, but let's just grab someplace up here. Oh, that didn't work. I didn't hit the Fibonacci retracement. I hit something else. So let me hit the Fibonacci retracement and try going to right. Right. Let's say right there. So a 62% retracement. Oh, did I do that? I guess I did that wrong. I went from bottom to top, and really what I need to do is go from top to bottom. Let me delete some of this stuff so we can see what the heck we're looking at. It's hard for me to see what we're looking at because all these drawings on the chart. So let's just let's click here and go all the way back here to the bottom. No, that's not what I wanted to do. I guess I guess we start here at the bottom and come up. Wow, 62%. I guess because I'm on a log scale. Maybe that's it. Yeah, that's why it looks so weird. But even a 62% retracement could wipe out most of what's happened since 2009. So just gotta be careful. The fact that the market always goes up, if this really is a trend that started back here in 1932, it's going to be going mostly down here in the next several years. So be very, 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 very careful. All right, everybody, until next week, thanks for coming in. We'll see you. Bye-bye.